We really can't, talk about this flow-through share without looking at the Canadian model. That's where this whole instrument was really born. It had its life in Canada for very good reason, and in fact, it's taken on a new meaning in the Australian regime as well. Many people don't actually know that we've got a system which tries to actually copy that in terms of what we call the 12J regime, a venture capital regime, and hopefully I'll touch on some of the reasons why, in my own view, that regime doesn't work for mining or certainly exploration ventures. But let's start off with the basic principles of what is the flow-through model. It's really a question around an instrument which is very much tax-driven to facilitate equity finance for prospecting ventures. And what's the reason for that? Simply because of the fact that that sort of spend is typically regarded as very high risk. And that's really the driver, the objective. If you ask me what was the simple objective of that, that's the reason for flow-through shares and the regime of a flow-through shares. What are we trying to achieve with this? Very simply speaking, it's an instrument which really addresses this conflict for tax purposes between the investor that makes money available into a company, and that company, typically ring-fenced entity, seeks to go into prospecting expenditure, and that venture fails, like many prospecting ventures. So where's that money gone? It goes into an abyss, because while that venture typically does not get any tax break. And if you look at the investor, well, he's put money into this venture and he gets nothing out of it. At best, he might get what we call a deferred tax loss for capital gains tax purposes. So it's really that mismatch that the flow-through model tries to address by saying that instead of giving the company, i.e. the prospecting entity, the deduction, why not give it to the investor? And hence giving it to the investor, making effectively the cost of that investment much smaller, take away some of the risk associated with that venture. Let's then look at very quickly the Canadian model. And again, it's very much along those themes. What you need is you have an investor that would subscribe for, again, a share in a company. It's called a principal business corporation. And the investor would effectively get 100% of the tax deduction on all what we call Canadian exploration expenditure. Okay. So again, see you're moving the deductibility from the company, from effectively the PBC to the investor, and that's the trick that we're trying to play on here. What does the Canadian model say? Well, it says that what we need is you need to get into grassroots exploration. So it's really trying to incentivize the most basics of exploration, and that's really around prospecting, drilling, geological surveys, etc. The stuff that I guess most of you people play with every day, but the stuff that you can't actually do. It's the cradle approach. You start off doing this thing before you can even get to ever build a mine, and that's what we're trying to get some sort of funding for. And in Canada, they're saying if you get that, we'll give you the deduction. And we'll give it to you up front as long as you spend the money within a 24-month period. So you're not deferring that deduction for the investor. Now what's interesting is that there's a super system in Canada which actually gives you an additional 15% credit in certain instances, and that is when you are really very much within the grassroots exploration phase, as opposed to trying to build a mine per se as such. And then the Canadian model, which is very interesting, then actually gives you certain additional benefits if you operate in certain of the municipal jurisdictions. What's interesting is that from the stats that we've collated, and these are stuff that you can pick up on the Deja Vu report prepared by PDAC, it's the most recent one, 2015. Very interesting. They've done a whole analysis depending on where you're going to do your prospecting, and that's the point here, is that if you take that federal tax credit, you take the provincial tax credit, your cost of $1,000 investment could range anything from $519 to $319. In fact, I've seen other stats that even brings that cost even further down. So that's the crisp issue, is that you're spending $1,000, and through some of the tax breaks, the incentives, your investors' cost definitely gets reduced significantly. That's really the incentive that we're talking about.